Okay. We're now going to get into specific tools used in management accounting. CVP analysis, cost, volume, profit analysis. We'll talk about what it is, talk about something specific related to it called the contribution margin. And then we'll use CVP for break-even analysis and profit planning. Then we'll talk about sensitivity analysis with CVP. This is the basics of decision-making using management accounting. The very basics. The idea being, if you know how much something costs, you know how much you're going to produce of it, you can figure out the profit. And how much you're going to sell it for, you can figure out your profit. And you can compare one scenario to another scenario, and you can make decisions moving forward based upon CVP analysis. The very basic CVP formula. Your total revenues, so everything you've sold, your total revenues minus your total variable costs, minus your fixed costs, are equal to your income. Nothing surprising there. You can break down revenues as being the selling price per unit times the quantity sold, and variable costs being the variable cost per unit times its quantity sold. And then with just a little bit of reorganization, your selling price per unit times the quantity sold, your revenues, are equal to your variable cost per unit times the quantities sold or produced, plus your total fixed costs, plus your profit. Okay? So the very basic formula that we will use is right here. And from this, you could do analyses. I'm just pre-introducing it here so we have an idea where we're going. We'll get into it in more detail. Some of the assumptions, simplifying assumptions that we'll make as we talk about it. Costs contain a fixed and a variable component. Our cost and revenue functions are linear. We know our selling price, we know our variable cost per unit, and we know our total fixed costs. And at least for the period we're working in, they're not changing. Simplifying assumptions. If we have a multiple product environment, where we have a mix of different products, the mix stays the same. And we're ignoring time value of money for this analysis. Now, all these simplifying assumptions, you could work through them. It's just more complicated. We'll keep it simple. So why do we use CVP analysis? To reveal the effect of decision making. One decision a company can make is between variable and fixed costs. A Ralph Lauren could decide to build factories in the US, very automated factories, and produce shirts here. Or they can decide to go overseas to Sri Lanka and have individuals, people, not in a very non-automated fashion, produce the same shirt in a variable cost environment. That's a variable or a fixed cost decision. Amazon makes a variable versus fixed cost decision. They purchased a company that is essentially an automated stock picker, not like picking stocks on the stock exchange, picking stock out of a stock room. So they have these machines that travel high speeds through their distribution centers, finding the product you want, picking it, putting it into a bin, and getting it ready for shipment, rather than having people running around their distribution centers. They opted for fixed cost variable. So you make that kind of decision based upon your business. Which one is better? Which one, if you know that you're going to be increasing your volume, which one would you rather use, fixed or variable cost? Fixed. If you could get something at a fixed cost and you know it'll handle much higher volumes, it'll cost you less in the long haul. If you're not sure about your volumes, you might want to have more variable cost so that if your volume is down, you're not stuck with the cost of the fixed cost, which you can't cover. So CVP is used for making some of those kinds of decisions. It's used to set product prices. What's the price that will give you the best mix of quantity and return? It'll tell you whether a new product potentially is worth introducing or not. Whether you should replace your current factory equipment or whether you should do a make or a buy option. Should you make it or should you buy it? And it'll help you, something we'll talk about in a moment, help you figure out your break-even point. It helps, firms work within their strategy. If you're a cost leader, you would use CVP to plan your manufacturing to the lowest cost. If you're a product differentiator, you would use CVP to assess the profitability of new features and functions. So here are just some ways that it can help you do analyses. I'm not going to go through them. Let's talk about contribution margin. Have you seen that in other classes? The term contribution margin? Yes? Again, not so much. A very important concept, contribution margin. This is our basic formula. We'll just manipulate it a little bit. The selling price minus the variable cost, okay, times your quantity is your contribution margin. That's the amount that you're contributing towards paying off your fixed costs. And when you've finished paying off your fixed costs, you're then contributing it towards profit. So your contribution margin is really the variable component of the CVP. Selling price minus variable costs times quantity. That's an amount that you then put towards fixed costs, and ultimately, once you've covered your fixed costs, you then put it towards your profit. You can figure out your contribution margin per unit, not multiplied by quantity, or in total. The contribution margin percent, just a different concept, is the contribution margin per unit divided by the selling price. So if you demand a 30% contribution margin, that means, if you're selling it at 100 and you have $70 worth of variable costs, $30, 70 minus 100 minus 70 is 30, over 100, that would give you your 30% contribution margin. Make sense? You can actually look at your income statement from a contribution margin perspective. Not for financial reporting purposes, but for internal purposes. So that would classify based upon your behavior, your fixed versus variable behavior, rather than products and period.
I thought I was going to have next page.
An example of one. We'll see it later, I'm sure. The break-even point. This is where profit is equal to 0. So it's your CVP formula, but profit's equal to 0. This is where your revenues equals your costs. So sales minus variable costs minus fixed costs are equal to 0. There is no profit. Visually, it looks like this.
This is your cost line.
Starts with a fixed cost, and then you have a variable cost above that. Start at 0 and you get a revenue for each product. Whoops. And that just goes up from 0. Where the two lines cross is your break-even volume. In this case, 25 units, whatever it is. This is your break-even volume, and this is your break-even dollar. Where the two lines cross. If you're in this zone down here, you're losing money. This is the amount of money you're losing. If you're up here in this zone, you're making a profit.
To understand,
Based upon our sales price, our variable costs, and our fixed costs, we need to sell 25 units in order to make money.
or in order to break even.
Everything over 25, we're now no longer contributing to the fixed costs. Our contribution margin is no longer contributing to the fixed costs. It's now contributing to profit above 25 units. We'll go through a little mini example here. We're going to show 4 different ways of doing it, because everything should have 4 ways to do things. This is the Microsoft model versus the Apple model. It's just one way to do things, whether you like it or not. So here's a contribution income statement, and we'll be using this as the basis for our example. The income statement shows the amount of sales, your variable costs. This is your contribution margin percentage. So your total contribution margin is $96,000. Fixed costs are $60,000, leaving $36,000. That's your contribution income statement. Some facts. See, the fixed cost stayed the same. Revenue is $75 per unit. Variable costs are $35 per unit. And to keep this simple, we produce the number that we sell in each year. So let's do the example. What's the break-even in units? Sales price of 75 times the quantity sold. We don't really know what that is. That's what we're trying to figure out, the break-even quantity, is equal to the $35 variable cost per unit times the quantity sold, which we don't know, plus $5,000 for fixed costs, and profit is 0. That's what break-even means. A little mathematical manipulation gets us here. And therefore Q is equal to 125 units per month. We can do it a different way. This is called the contribution margin method. The number of units are equal to your fixed cost plus 0 profit, because this is break even, over your price divided by variable costs. Same answer. If we want to do it in sales dollars per month rather than units, your sales dollars are
your total variable cost versus your total
revenues times the monthly amount plus fixed income,
fixed costs.
plus 0.
This is your contribution. Well, this is your variable cost percentage.
And you get 9,375 per month. Could do it the other way. I'm going to give you guys a chance to do these, by the way. It's hard, very hard to teach and to follow numbers on the screen. I understand that. So we'll get a chance to do it. Okay, so a couple of questions for you. If a new product does not require any additional fixed costs because you have excess capacity, what's its break-even point equal to? It's a conceptual question. It's not 0. It would be based on your variable costs. If you had excess capacity and no new fixed costs, your break-even point is your variable costs. Every dollar you could sell it for more than your variable costs will contribute to profit. Okay? You get to do a little bit here. Find the break-even point for this scenario. This is break-even point in quantity. I'm sorry,
This is break-even point in sales dollars.
you can't find quantity. We don't have quantity information. Based on this, right? No, based on this one. So this is the formula you'll be using. Sure. V is variable cost, P is sales price. Who thinks they have it? No, sure how you did it. You used the formula. Thank you. Are you buzzed now? Or? You're good. And this is in dollars, so I'm just going to put the dollar sign on so there's no confusion. So are they breaking even?
Yeah, they're actually making some money, right? Because they sold $750,000.
This says they needed to sell $300,000 worth of goods to break even. They in fact sold $750,000. How much profit did they make?
$750 minus 500 minus
100. 150. Well, companies don't go into business to break even. They go into business to make some kind of a profit. It's the same thing. Instead of just having the fixed costs in the equation, you also want to have some expectation for profit. So instead of that being zero, you have whatever your expectation is. And you do the same math. So if you have a business that requires a 30% return on sales, you can then figure it all out. The indifference point is the point where if sales are greater than a certain level, you would go for fixed costs rather than variable costs. So again, operating leverage. It's called operating leverage. You get to make a choice. Do you want more fixed costs or more variable costs? And you want more fixed costs if you have a stable business. Some businesses have a lot of fixed costs. Nuclear energy, a lot of fixed costs.
So you need to figure out the level of sales that would favor fixed costs.
Okay, so profit planning. The same company has to decide between two machines that will do the same process to the same quality. One will have a higher variable cost function and the other will have a higher fixed cost function. The indifference point between those two machines are the ones where above that level you would want more fixed costs, below that level you'd want more variable costs. So model A, machine A has a $5,000 fixed cost plus a variable cost of $10 times your quantity. Option B has a higher fixed cost, $15,000, but a lower variable cost per unit. You do the math. 2,000 units is your indifference point. You don't care which machine you have. If you're going to have if you know you can sell 3,000 units. Which machine are you going to go for? You know you have a pretty good flow of business. 3,000 units. Which machine? Which one? B. Increased your fixed cost versus your variable cost. Just to prove it, what's the profit for each of these with 3,000 units? At 2,000 units, they have the same profit. I'm sorry, what's the cost? This isn't profit. What's the cost? What's the cost of A for? This is 35,000 cost. What's the cost of B? 30,000. Costs less because you've locked in your costs with fixed costs. More operating leverage. So we've been ignoring taxes. It's just a complicator. We want to figure out our before-tax profit if we know our after-tax profit. You just divide your after-tax profit by 1 minus the tax rate. In this case, it's 20%. That'll give you your before-tax profit. So when you look at it as from a before-tax basis, $3,000 units becomes your quantity. Okay, you get to do one. How many headphones must they sell to reach their goal? Want to see the formula again? Do one of you guys have it? You don't have it? You got it?
I think so.
What do you got?
65.
Yeah. Can you put it up? Who thinks they have it? He's got it. A little pressure right here. What's that? No. Well, you don't know that. They don't know that you know that. Good. 65. You guys get it? Good. Thank you. Sensitivity analysis. You've probably seen this in other classes. So the idea of sensitivity analysis is you vary one variable and see how that changes things. So let's say you don't know whether you're going to sell 100 units, 200 units, or 300 units, but you know it's going to be somewhere between them. You can see what that does to your profitability. You can do what-if analysis. That's the 1, 2, or 3. Margin of safety and operating leverage. 3 different concepts of sensitivity analysis. What-if analysis is you take one factor and you just vary it, as we said. You want to see how changes in volume will affect your profitability. That's sensitivity. That's what-if analysis. You can vary price, volume, variable costs, or fixed costs. The margin of safety measures the distance between budgeted sales and the break-even amount. That's your safety level. So you have a budget that says we're going to sell 100 units. We've calculated that 80 units in order to break even. That's an indicator of risk. If your budget is close to break even, you're at risk of losing money. So your margin of safety is how far you are from breaking even. And you could look at it as a ratio, which is just your margin of safety divided by your budgeted sales. So that's a percentage above break even that you would be. Operating leverage, as we said, greater operating leverage is replacing variable costs with fixed costs. It's higher risk. You're fixing your costs. In theory, it'll work out to be lower per unit, but if you don't meet your numbers, you still have to pay those costs. So higher operating leverage is more risky, but more reward. It can be measured as your contribution margin over your income. That's your leverage. So as we said, the higher the percentage of fixed costs, the higher the risk. If you're a cost leader, you're probably going to be in this business because you're going to make your money through high volume sales, low margins, high volume sales. So you would want to replace your variable costs with fixed costs because you need those fixed costs. You need to reduce the cost per unit. So if you have high operating leverage, you're going to be working hard to get that increased sales because more of the sales go to the bottom line. They don't go to variable costs.
Okay, we're going to do something different. We're not going to do these breakouts. Going to give you a problem from the text. You'll hand it in as a group. When you're done, you go. Okay?
Sound okay?
So we're done.
I have two problems in mind. I want to see which one makes more sense. Problem 318 on page 87 in the text. Sunny Spot Travel Agency. So as you complete it, make sure you put your team name just